in order for you to be able to utilize the benefits of a bucket company and how this structure works, you need to be able to have surplus income that you don't need immediately now. So if you're making debt repayments on the mortgage, for argument's sake, there's not really any benefit because it's going to go to a bucket company, you're going to pay 25% tax.
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are back on the audio waves, bringing a whole heap of value.
Back on the wireless, Andrew.
Exactly right.
Andrew, I love this one because we're talking about tax. And everybody loves to hate paying tax.
Everybody loves to avoid paying tax. Well, what is it? It's not illegal to minimize tax, but avoid tax is illegal.
Tax evasion.
Tax evasion. Yes,
Something like that.
Either way, it's a wordsmith way of basically saying you want to pay less tax, but do it legally.
That's it. Andrew, we're going to start with talking about a bucket company. And what does that mean? Because, it sounds good. A lot of people throw that term around. We're going to do a deep dive and explain to people what that is and essentially how that is used. Probably more so for people who have got more assets or more income. This tends to be a strategy that they tend to sort of move towards.
Yeah.
So, Andrew, let's kick it off. What's a bucket company?
A bucket company, it's essentially a company that receives distributions from a trust. So we're going to take it one step back and say, okay, what's a discretionary trust? How does that work? And why do people utilize a discretionary trust? And then we'll maybe distill it down a little bit further into bucket company and how that plays into it. But essentially, I'll use, let's say, Billy and myself in an example, right? And let's say that we both own a business together and we're a family unit, for argument's sake. Money is made in that business. The business is a trust. The business must distribute its profits. So when you have a discretionary trust, you can choose who you distribute profits to. Maybe Billy takes 100 grand of the profit and I take 100 grand of the profit and we split the profit equally.
Let me just jump in. So we're the two beneficiaries of that trust.
Correct.
So we can decide, we've got the discretion to say which of the two beneficiaries receives that distribution.
And let's say Billy decides 1 year, okay, well, he's not going to earn any income in the business in the form of PAYG income because he's decided to go on holiday for a year. So we're going to actually distribute the majority of the profit income into Billy's name because he's going to work his way through the tax bracket rather than distributing that equally, in which case I would potentially already be our highest marginal tax rate. So a discretionary trust is essentially where two beneficiaries own an asset, generally a business is what we're talking about here. And what you're deciding is who receives the profit distributions of that business in a particular year.
Okay, got it. So going one step further, how does a bucket company then fit into it? So let me just set this up. So in this instance, we had two beneficiaries. If we created a bucket company, what we'd be doing is creating a company that then becomes a beneficiary of the trust. So in the example that you gave, there was two people that could receive a distribution, Andrew and Billy. Now we're creating an entity that gives us a third option to be able to distribute income to.
Correct.
Okay.
Correct. Third entity is a company. Now, if you distribute income to an individual, they will pay tax at their marginal rate of tax. So in this scenario, I'm going to assume that the two beneficiaries, Billy and myself, are both at top marginal tax rate of 47%. If you distribute to a company, you're going to pay income tax at company tax rates, small business, so let's say 25% company tax rate. So by distributing income to the company, you're essentially avoiding paying 47% tax because you're both on top marginal tax rate and you're paying tax on the profits at a rate of 25%. Gotcha. Sounds good. Sounds great.
Sounds great.
Sounds great. Bills, let's say you've distributed money to the company. Now I want to spend that money. So this is where it maybe gets a little bit.
So here's the clincher, and this is the reason why I think it's probably misunderstood a fair bit. But just going back one step, so whenever you receive a distribution as an individual, it forms part of your assessable income, right? So if you're already earning the top marginal tax rate through your work, if you receive anything above and beyond that, and you're at 47%, you're going to lose 47 cents in the dollar for every dollar of distribution that you get, right? So whenever it lands in your personal name, it hits your tax return. It forms part of your income. Putting it into a company allows you to pay 25% at the time that that money gets transferred. But then when you want to take it as an individual, it then hits your marginal tax rate, it hits your income, and depending on what your marginal tax rate is at that point in time, you will pay the top-up tax. So as an example, if we contributed money into this bucket company this year, and then in 3 years' time, we decide to take that money out of the bucket company, and we're at 47 cents in the dollar, we will pay top-up tax of 22 cents, 22%, going from the 25% that we've already paid to the 47 cents in the dollar that we paid from a tax perspective. So it's a tax deferring strategy. So then you can withdraw the income at a more favorable time when your income is lower.
Yeah. So in essence, a bucket company is going to reduce your tax today. Yeah, but at the point in time in which you want to utilize that money, you're still going to pay tax.
Depending on your position.
Marginal rate of tax.
Correct.
And so in essence, you're not actually avoiding paying tax by putting money into a bucket company. What you're doing is deferring the tax obligation to a future point in time. And what your taxable income is at that future point in time will determine how much tax you're paying at that point in time.
Correct. So in the example that we were using, you'd pay the top-up tax when you eventually take it out. But where this becomes really, really powerful and it can work in your favor is if you put the money in the bucket company, you pay your 25% tax today, it stays there until circumstances are more favorable. So let me give you an example of just one real easy one.
Yeah.
Your spouse at some point in time is going to go on paternity leave.
Yeah.
In that, because they're, obviously, in that year, their income is going to go down because they're not working. So to supplement their income and to pay less tax, you do a withdrawal from the bucket company into their own, obviously, name.
Yeah.
And then whatever the tax rate is at that point in time, that's the effective rate of tax that you will pay. So assuming that they're earning less, maybe they've gone down to a marginal tax rate of 30%, you might withdraw that money from the bucket company, you pay the top-up tax, because you've already paid 25%, you pay the top-up tax at 5%.
Yeah.
So at that point in time, you're only paying 5% tax, but overall on that money, your effective tax rate is 30%, as opposed to something more aggressive like 47%.
Yeah, correct. Or where it can become incredibly powerful, and we'll talk about this a little bit more in the future. Let's say that you've got the wherewithal to keep the money in the bucket company for a period of time, and you say, I'm actually going to get not all, but a large portion of the profit distributions to go into the bucket company, pay 25% tax. Wait until a future point in time in which I'm, let's say, retired, no longer generating an income, and I'm generating income for the bucket company to supplement my lifestyle. And all the meanwhile, I've only paid 25% tax. You might be at a 0% tax rate at that point in time. You then start talking about franking credits and then potentially getting a refund of tax. But there can be some pretty crafty strategies around it. The thing that I just want to get clear in this, though, is in order for you to be able to utilize the benefits of a bucket company and how this structure works, you need to be able to have surplus income that you don't need immediately now. So if you're making debt repayments on the mortgage, for argument's sake, there's not really any benefit because it's going to go to a bucket company. You're going to pay 25% tax. It's going to go to you personally, and then eventually, you're going to go back to your normal marginal rate of tax. And so, unless you're not just deferring the tax obligation, you're also deferring being able to utilize those funds for a future point in time as well. Now, so there can be some, really crafty strategies that you can start to unpack with all of this. And we're just going to keep it fairly high level for the sake of this test. But you need to be sure that, or not you need to be sure, but you need to make sure that you're going to have the surplus income to not need those funds for a period of time.
And the other thing, the setup and the cost associated with this, the added complexity does cost. Time, burden, compliance, you name it. So you're going to want to make sure that it's worth it for you or what your circumstances are going to be in the future. One of the other ones that's really beneficial as well too is adult children.
Yeah.
So if you've got a child and then they turn 18, obviously they can get a tax file number, they can pay tax. You can distribute money to them. Now, the money has to go to them. You can't just put it into their name on paper and then you take it. It actually has to go to them. So that's a bit of an issue depending on the relationship with your kids. Maybe they're old and mature enough to be able to say, hey, you're going to receive this money. I would prefer if you invested it or did something worthwhile with it.
Yeah.
But that's sort of specialist tax advice and stuff. Talk to your accountant about that. But yeah, there is a lot to be able to do with this from that perspective. At least at the moment, who knows what the government's going to do if they're going to see this and try and get their hands on it. We'll wait and see. We're not sure. Andrew, one of the things from a compliance perspective is if you run afoul of this and you take money out when you're not meant to, if you're meant to make a contribution to a bucket company and you don't do that and you've used that money yourself, you do get charged penalty interest. It is called Division 7A. So one of the things to be mindful of is that from a record keeping and from an intent perspective, you need to keep your nose clean on this because it can cost money in the form of penalty interest with this as well too. So there's more complexity with it. There is a benefit if you have the right set of circumstances, and if the benefit is going to be big enough that you want to go through the additional cost of setting it up, managing it, running it, and having a little bit more complexity in your circumstances, it definitely can work out and help. But ultimately, this is a way to defer tax, at least in the initial part, and then above and beyond that, if the set of circumstances are correct and present themselves, to pay less tax eventually.
Yes. And look, I think this is one of those strategies, and similar to when you're starting to talk about debt recycling or something as such, this is one of those strategies that you need advice on. Some people can try to, but I wouldn't be setting up a bucket company without, specialist tax advice, without making sure that I'm getting the right people in the room and receiving the right advice. Because things like a Division 7A loan is so easy to unintentionally fall into, a trap like that. But the risk is huge. One of the strategies that, some people will utilize to, distill some of the benefit and details is, let's say that for a portion of your income, you're going to invest in managed funds, in ETFs, in shares, in property potentially. And that's always going to be the case with a portion of your income or a portion of those profit distributions. What you can do, or what some people will decide to do in this scenario, is rather than take a distribution, pay 47 cents in the dollar, and then invest 53 cents of every dollar that I have. What I'm going to do is actually move the profit distributions to a bucket company, pay 25% tax, have my funds invested in a bucket company. So actually investing in that bucket company, all of the earnings that are associated with it are now taxed at 25% as well. So there's also a longer term tax benefit around the investments because it's invested in a company structure, but I'm never actually kicking that money out to me. And because I'm not kicking that money out to me, I'm not going back up to my marginal rate of tax, and I'm able to invest 75 cents in the dollar as opposed to 53 cents in the dollar. And at a future point in time, yes, I will be, drawing the money out and creating a level of passive income, but I'm going to do so at a point in time in which I'm, let's say, retired, not earning any income, and I'm doing so with franking credits and along the way. So one, it's not just the fact that, okay, I'm not going to pay tax, or I'm going to pay tax of 25% on this money, but I also have the ability to invest 75% of my dollars. So there's the compounding effect of having more funds invested, more money invested along as well. It can be hugely beneficial.
Look, it's for a lot of people, it can be a really good strategy. I think a good call out here is that generally for business owners, that seems to be where it's at. High income families that are already at their top marginal tax rate, and people that want to defer their tax and have reinvestment capacity. So that's probably the set of circumstances. But where we do see it, I guess, the most is with people who are self-employed and are running their own business. Usually less of an opportunity if you're PAYG, because when you're a PAYG employee, you don't have the ability to be able to push your income, to distribute your income anywhere. It has to go directly through your name. You don't have any choice associated with that. So yeah, that's Andrew. I think we did hopefully that one a bit of justice, but bucket company sounds cool.
It does. It does. It almost sounds like you're doing, something illegal, like putting money into, a company in Panama and paying no tax. But we're not going to go into any of that.
Are you still paying tax?
Yeah, exactly right.
Just hopefully less.
Hopefully less. That's exactly what we want. But Bills, thanks again for another great podcast. Good to jump on and give some more value to our listeners and our viewers.
And if you got a whole heap of value out of that episode, I normally don't do the closing, Andrew, so that's all right. I brought it on to you. Hopefully, if you got a whole heap of value out of the episode, like, subscribe, share with your family and friends. If you want any further information or want us to have a chat about your circumstances, reach out to Andrew and myself. Details are in the show notes as always. Andrew, thank you once again.
Thanks, Bill. Look forward to catching you on the next one.
Thanks.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
The information in this podcast is general in nature and does not take into account your personal objectives, financial situation, or needs. It is not financial, legal, or tax advice and should not be relied upon as such. You should consider whether the information is appropriate to your circumstances and seek professional advice before acting on any of the information provided. Past performance is not a reliable indicator of future performance. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorized representatives and credit representatives of Akumin Financial Planning Pty Ltd.